Hi folks, please read the disclaimer. This is a very nice infographic from ET. It is showing all the different asset classes and the segments within equity. So you have silver, you have G-Secs, gold, real estate, short-term debt, equity, mid-cap equity, large cap equity, small cap. And for each of the years, the ranking is there, which asset class did the best, how it has moved around across different years, and the 10-year returns on each of them. So the best returns that has been achieved is by equity mid cap at 16.1% in the last 10 years. Gold is at 13.9. Equity small cap is at 13.2. Very surprising. Silver is at 11.9. Reasonably good outcome, I would say. Large cap is at 11.8. G-Secs are at 6.9. So buying bonds is really pushing you back a lot. And these are all pre-tax returns. Debt short term 6.1%, real estate 5%. Again, real estate can depend upon the source of the data, which usually these tables take from the government, NABARD, or some other sources, and it's really not reflecting what is happening on the ground. So anyhow, the main sort of focus area here is that if you were invested in mid cap, small cap, and large caps, you were not in the top three from a returns perspective. So there needs to be a scenario where you need to mix and match different asset classes within your portfolio, because each year you find that a different asset class will top the table. There is a year where silver did 45%, and there is a year where small cap did 54%. But it won't happen every year, and there will be reversion to the mean and rotation amongst all these asset classes. So good allocation to different asset classes, and also studying whether, let's say, small cap versus gold, for instance. The returns are very similar in the last 10 years, but is the volatility the same? Gold is probably much lesser volatile than small caps. So if I'm invested in small caps and I'm having to bear the volatility, and yet the end result is similar to gold, why would I take that volatility? Or at least I combine it with gold to reduce my volatility. So this is something that all of us need to be aware of. A lot of folks just want large cap equity, but large cap equity is not yielding you, the kind of returns, that alpha that is needed. The government says we are at 5% inflation, but perhaps we are at 10-11% inflation. So you are barely matching inflation when you're investing in an instrument. Or G-Secs, in my own view, G-Secs and short term, a lot of folks 90% investment in these two, some even 100% investment in these two. You are losing ground because inflation is much higher than the stated figures, and post tax these numbers are pushing you back. So take some risk, 10%, 20%, 30%, and also move into other categories. Let me know your thoughts on this. Thanks. Bye.